This is the Millennials in Multifamily podcast, brought to you by Kronos Investment Partners. We interview industry experts to unlock key information that will help young professionals break into the multifamily world in order to create long-term and short-term wealth. If you enjoyed the show, please head over to iTunes and leave a rating and written review so we can reach more listeners.
Hello, and welcome to another episode of the Millennials and Multifamily podcast. I'm your host, John Stubber, with my co-host, Fritz Ritter, and today our guest is none other than Benjamin Inman. Ben is the founder and CEO of Inman Equities, a privately held real estate investment company with offices in Nashville, Tennessee, and Atlanta, Georgia. They currently have over 2,500 units under management and are still acquiring well-located assets throughout the Southeast United States. Benjamin Inman, thank you so much for joining us on today's episode of the Millennials and Multifamily podcast. Could you just give us and our listeners a little bit more into your background and how exactly did you get into the real estate investing business?
Yeah, so that's a loaded question. I tell people, I started my career from the ground up, literally. I started as a landscape architect. That ended up landing me a position with a big developer down in Miami, where I oversaw all their exterior projects. And then it moved on into the interior renovations, and then rode that wave out for a few years, and then, went from there to, that takes us back into 2009 when the economy crashed. I moved back to Nashville, started a pretty successful marketing company. And then when the real estate industry started popping back up around 2012, it's when I went back into the real estate business on the brokerage side. And that's when I just got kind of a taste of that, which I was familiar with already, and just went from there. I went to work, as you guys know, I went to work for Grant Cardone for a while. And then from there, ended up leaving and starting my own shop 3 years ago. So that's, nutshell version, but, and I'm happy to dig into any of that further.
Yeah, let's dig. So I'm curious, it sounded like before you joined Grant Cardone's company, you had a lot of experience, with development. You worked at Marcus & Millichap. Why did you feel the need to go work for another shop before you went off on your own?
As far as another shop, like with Grant?
Yeah.
Marcus, yeah. Well, so when I was at Marcus, I was dialing for dollars, right? And so I just wanted to learn that business a little bit more. And I happened to call on this guy named Grant. Did not know who he was. They picked up the phone. The receptionist did, and she said, told her what I was looking for. And it was about 3 specific properties that he had. And she asked me, she said, well, are you calling about the properties or are you calling about the job? And I said, well, as a matter of fact, I'm calling about both. I didn't have any idea what that even was. So she patched me through to one of his assistants, and she said, yeah, send us in a video and tell us why you're fit for the job. And I said, well, can you tell me a little bit about the job? So she told me, did a video, sent it in. A few weeks later, I had an interview. And yeah, it's just, I guess to help answer your question, why did I want to go to the shop? I wanted to make sure my toolbox was ready, I guess I should say. Because I had been in the business now for almost 20 years. And then, right before I started working for Grant, I wanted to just learn a little bit more. You never feel like you're ready to take that leap. And, once I got in there, there's some things I learned, directly and indirectly. It just got to the point where when it was time to go, you felt like you were ready to take that leap. And it felt very comfortable to the standpoint, not that it wasn't challenging, because it was, but it's almost like when you get married and have a baby, you don't get to the point where you're ready. You just do it. Right. And not prematurely, of course, but you really want to think that, okay, I think we can do this, financially, mentally, career wise and everything else, because, it obviously changes stuff. So, but I wanted to take another step just to kind of help further sharpen my tools before I went off on my own. So that's what I did. I'm glad I did it.
So can you talk more about, while working for Grant, what exactly were those tools that you were sharpening? It seems like, you did the landscape architecture, and then you work for the brokerage. Those are more indirect ways to learn the business. And then you go and work for Grant Cardone. It's no, this is the role. This is what you're going to be doing in the business. Yeah.
Yeah. And so when I was there, there was nobody in the real estate shop. So, I came in there, and then, Ryan came in under me because he was full-time pilot, right? And so he kind of stepped in, and then we ended up hiring a couple more assistants and stuff. So while we're in there, it's just, a very fast-paced environment, which I really enjoy. So the deal flow was coming in. You had to underwrite the deals, and they had to get them out. So the good thing is, we were buying properties with grants on equity, and that's before we started doing the syndication stuff. So really, there's some things that Grant said that made sense. Some things he said that didn't make sense. And at the end of the day, I think the biggest takeaway that I learned is Grant's not the smartest guy in the room. All right, he doesn't try to be. So that's no insult to him, because he'd be the first one to tell you he's not the smartest guy in the room. Matter of fact, he used to always tell me, never be the smartest guy in the room, because if you are the smartest guy, then you're probably in the wrong room, right? And so at the end of the day, I just gathered that, hey, here you have this guy. He's not the smartest multifamily guy on the planet, but he executes. And that's really what it came down to, because the prior developer that I mentioned I worked for in Miami at the time, or some years ago, it was the same way. He started his businesses from the ground up. And this guy still hustled, showed up to the office, first one to get there, last one to leave. And you just see these guys working that way. And I had always had that in me. You just never felt like it was appreciated. So you just grind it out and hustle. So I think the biggest takeaway was, you don't have to be the smartest guy. You just have to out hustle the smartest guy.
Mm-hmm. And so you mentioned the deals are coming in, and then you're underwriting them. Could you talk a little bit about what does that underwriting process look like?
So we would, get, and even the same thing applies today, right? So we would get the deal flow in, and then we would, call up the broker. We'd download all the documents out of the war room or Dropbox, whatever you want to call it, because it's different shops call it different things. But pretty much you get all the files in your hands. Then you get on the phone with the broker. You kind of talk through the deal, find out what the whisper price is, or what the pricing guidance, different lingo in the marketplace and what that's called. And then you just kind of dive into the numbers and see if the numbers work out. And then you look at the comps, see if everything comps out, see if the numbers work. And if they work, then kind of high level, then you schedule a time to go see the property, and then you go shop some of the comps in the area to get really comfortable with that property, to see if it's if it warrants further analysis, because I always start out on the macro and then dig into the micro only if it passes the sniff test. Mm-hmm. And really, with Grant, there were spreadsheets that they were using, which are good spreadsheets, but at the end of the day, we just had to find a way to be efficient. So I created a one-page, just a one sheet. I still have the thing today. I don't use it anymore, but it pretty much is just a very high-level sniff test. We call it a litmus test, is what we had it saved as. And we just plug in the numbers, and if it worked on that, then it went to the next file to where it got underwritten a little bit deeper. So really, it's just finding your process, and depends on your deal flow, depends on how you need to structure that, I guess.
So how did your experience being the landscape architect and working for the developer, how did that help with your underwriting when you're actually going and shopping the properties? Did it make it easier to translate the numbers onto paper?
It did, because I knew from our experience, thankfully I had a really good experience with that developer, because not only was I the architect, but he was also, when he hired me for that, he was hiring for a project manager at the same time. And I told him not to hire that person, that I was going to fill both roles. And I did, for 3 years, 3.5 or 4 years, actually. But the way that he had it structured, instead of designing the landscaping and then go out and hiring a contractor to actually do the install, we went to the nurseries, to the growers, and actually bought the plant material directly. So we got to buy it at pennies on the dollar compared to what it would cost if you were to buy it from just a landscape contractor. And so knowing that's how we source the material and the labor. The material was the plant material, the mulch, and whatever else, the irrigation systems. And then we have the install crews that would come in second. So knowing how to structure that efficiently so it cuts costs by roughly 30 to 35%. And that translates over into the renovation materials, to where, knowing how to source, cabinets and light fixtures, plumbing fixtures, flooring, paint, things like that. So, when you're walking these units, I can look at things at a glance and know what it's going to cost without even I don't have to get my checklist out. I'm just so attuned to it that I can just walk in there and tell you exactly what you need. But it just takes time.
Right. And so did any of that translate into when you're looking at the T12, such as when you're looking at the expenses where you're just I can cut this, or this is too low?
I don't think overseeing any of the landscaping or the renovation projects helped in that is more on the management side, being involved in the management side. Now, what we did is we were so involved with the weekly management that we would get on the phone calls. We actually set up a sales call, a weekly sales call is mandatory for leasing agents and property managers to get on to the sales call with us to really help walk them through. They knew the leasing, but we knew the sales, and it's a sales job, right? So you just got to focus in on closing, like what's your delivery, what's your presentation, what's your close rate. And so we just had to take what Grant was teaching in those packages and translate it over to the multifamily space, which worked quite well. And so, knowing what those numbers were from an operational standpoint, from your R&M cost to your payroll cost, your marketing cost, your admin cost, and such. So when you're going through someone else's T12s, what those average numbers should be, and so if that seller is overpaying for things or if they're underpaying for things. And if they're underpaying for things, you got to know, how are they doing that? Because I've seen it both ways. I'm actually looking at a deal, have a property in the contract right now, to where the R&M costs were way lower than I've ever seen. I just didn't believe it, so I put in my numbers the higher number that I know it's going to cost us, and the deal works. But now that we got in there and we interviewed the staff and did all the due diligence and walkthrough, the reason why the numbers are so low is because they actually do everything in house. So they don't have to hire out third parties, which really does cut costs down. So if you have a team that's that skilled, then you can be surprised. So again, I guess kind of works both ways. You got to know where you can shave the cost, and you got to know where you need to increase the cost, I guess.
Right. So it's like coming up with your own budgets and your own numbers.
Correct. And a lot of it just comes with time.
Yeah, Ben, I wanted to dive into what are some of the scripts or tricks that you taught the leasing agents to help them close on more tenants?
Oh, man, that's taking me back like conversations 3 years ago. Basically, I'm gonna answer this the best way I can without embarrassing myself, because I really, it's been so long. But great question though. You got me on that one.
Sorry.
No. So, basically, it goes back to what I said a minute ago, that, leasing is a sales job, whether you're a single person manager in the office that, doubles as a leasing agent, or whether, you're a 2-person office staff and you have a manager and you have a leasing person or persons. You got to make sure that things are being pitched correctly, right? So we want to take them through, like, you have a tour path, right? So you want to take them on a walk around, certain parts of the property and show them certain things, because number one, you got to get them there. Let me start there. I should have just kind of paused that and back up. So you take the call, because not everybody's just going to walk in off the street, right? And so sometimes that starts with the phone call, right? So you got to get them interested. And one of the things that I would always tell them is, there's a lot of properties in the market. Let's just say that, I'm just going to make up numbers here. You have a 1-bedroom unit that's $500 a month. Your neighbor down the street has a property that's $525 a month, right? So their rent might include water. Okay, for $525, you get water and your rent, water and sewer. On yours, you may be $500, but you guys are trying to charge $45 a month for water and sewer. So instead of that tenant calling you and saying, "Hey, what's your rent?" say, "Well, $545," right? Because in your mind, you're combining the water, sewer, and trash with the rent, and they just called down the street and were told $525. Guess where you think they're going? They're going to the property down the street. And so I don't want them to quote that water charge. I want you to quote the rent, the base rent charge. And so they just called the place down the street, because you have to assume that every call you take, they've already shopped the competition, right? And so let's just say you called your competition. It was $525 a month. Water, sewer. Maybe that agent on the phone clarified that. Maybe they didn't. But when they call you, what's your rent? Oh, ours are $500. Okay, great. You're less than the people down the street. You know what? We're also the best. So you got to get them in the house, right? And then when you get them in there, you sell them on the property, the visual. You got to sell them on why you guys, your staff, care about the tenants. You're not just trying to put a body in a room. You really have to truly care about people. And so then you get in there and say, well, our rent's $525. Then you have water, sewer, and trash, which is extra, which is $45 a month. And that's when you kind of go through all that. And you just kind of let it roll off naturally. You're not selling them, because it's mandatory. Like, you pay this $45 to us, or if you were to go get the water, sewer turned on in your name, it's going to cost you the same amount, if not more. And so that's one of the strategies that we focused on, is just quoting baseline numbers over the phone to entice them to get into the property. And then when they get to the property, you have to sell them on you and the property, right? And you got to have a personality. I mean, my gosh, I've talked to so many people that sometimes you just want to hang up the phone because they're that boring to talk to. And it's really detrimental. I mean, it really is. And I have some people that, there's a property we're buying right now that, the leasing agent, she's very bubbly, but apparently, behind closed doors, she's a very toxic person. It's like, you pick your poison, so she's great leasing. As long as she leases, then, we can help coach the devil out of her, I guess, on the other side of things.
So when you're dealing with the third-party management companies, though, how much do you like to actually control what they do versus like letting them implement their own systems? What's the line between like micromanaging and
there is no line. No, but it's a good question, because a lot of people are a little bit different, right? Is because I always go back to the, Jim Collins wrote a couple of good books, or actually a few good books, Good to Great and Built to Last, right? And two very, very good books. But it's about putting the right people in the right seats and letting them do their jobs. So and the analogy is right seats in the bus. And so, so I want people to do their jobs, right? You want to hire them and give them the freedom to expand and grow and do the things. But at the same time, we're very hands-on. So we're probably a little bit different than a lot of people for that reason, because we're very involved, because we care. And because we have performance metrics to hit, for us and for our investors, right? So at the end of the day, most of my investors know, hey, leave us alone. Let us do our jobs. We will focus on operating the property. And my question to some people is, do you want me to take your phone calls, or do you want me to operate the asset? Because, there are some people out there that are just really annoying, right? When it comes to, they want to know everything. And there's nothing wrong with that, because I tell all my people, if you need me, you can call me. You can text me. If I'm available, I'll pick the call up. I'm not telling you not to call me, but I need to operate the property. But the reason why we are so involved is, in the event that we do get those phone calls, I want to know what's going on at the property site level, from renovations to leasing. I want to know where occupancy is, how many vacancies we have, how long they've been vacant, what's being done to turn. So we want to do it. So even though it's like, let us do our job, it's still, I'm ready for those phone calls if they come, because they can, and they do come. I get text messages, calls all the time. And thankfully, I don't have to go back to anybody and say, let me get that answer. Chances are pretty high I already have that answer, because we're so involved. But we do give space there, but they know we're going to show up unannounced.
And when you don't, it's like when you don't have the answer too, then it just gets like their red flags going, and they just ask a whole bunch of more questions, and there's just more opportunity for a screw up.
Correct.
Yeah.
But you need to know anyway. That's my argument. It's like, I want to know.
Yeah.
Ben, I wanted to go back to that R&M that you're talking about on this current deal you're looking at. Do you look to bring R&M in-house now that you've noticed how much of a cost savings it can be? Or is that just kind of a one-time thing on this property?
I mean, I think it's just a testament to the preparedness of the staff that's there. I think it certainly is a good thing for really any owner operator to shoot for, because it can only benefit you, because if your on-site staff is strong enough to where you don't have to hire out third parties for certain things, and I mean, that's only a good thing in my opinion. Because I mean, I will tell you that, on your R&M cost, you're looking at, on our models, the average cost is anywhere, depends on the age and the size of the property, but I'd say it goes anywhere from $750 to $900 per unit. And this particular seller had like $350. And I was like, there's no way. And then once we got in there and we got to interview the staff and talk to everybody, we realized that, hey, this is working for these people, and it almost helps you be inspired to let you know it is possible, that you can go out and you can get, pretty much train your staff to be the same way. It's just about getting the right team in place.
So what are some things you ask the staff when you interview them? What are you trying to uncover?
Because you assume that they're qualified to be there, right? Because somebody's already interviewed them. They got the job. They're performing in the job. So they're still there. So if they're employed, that means that they're at least doing something right. Okay. And so, but when we get in there, we want to know, how willing, how passionate are they about their job? And the people that are the most passionate, I would say, and I could be wrong in saying this, but I'm going to say it anyway. The people that are truly passionate and truly care about that property and about their job are the ones that are going to be the most willing to spill their guts and spill the beans, whatever, and tell you what you need to look for, what's wrong with the property, what's wrong with the staff. Because interviewing somebody, it goes beyond just their qualifications. You want to learn their personality type. In the case of the three maintenance guys that we just interviewed on a property that we have in the contract right now, one guy was very knowledgeable, very hard worker, and he was the supervisor. That's obviously not shocking. The second guy was very skilled, and he was making, of course, a little bit less. And then there was a third guy, and they both had, good personality types for what they did. And then there's a third guy that I actually was not in that meeting, in that interview, because I had to take a call. So the manager, my regional, had to step in and kind of facilitate that one by herself. And at the end of that conversation, that interview, she and I were circling up, and she said, this third guy, I don't know. She said he's qualified, but I would ask him questions and he would have like one word answers. So that tells me that the way that she was presenting it, that he was like an extreme introvert, which is not necessarily a bad thing, right? But her concern is that, well, he's not a people person. So, he can't really go in and, be good to the tenants and know how to communicate and be friendly with everyone. But, my argument back was, if the guy works, I don't care if he's a people person, because if you need a people person, he can call a supervisor in there. It's just the way it is. It's like, you can't make everybody be everything, right? And so if the guy is really good, or girl, whatever, and that's their strength, let them be good in that strength, because I'm okay with that, because not everybody is that bubbly personality type. I can be both. I can be tough. I can be, very extrovert. I can be very introvert. So depends on the day, I guess. You call me at 8:00 at night, you may get the extreme introvert side of me. But you call me in the morning at 8:30 after I've had 3 cups of coffee, you're going to get the complete opposite of that.
That's why I work with Fritz. He's the bubbly one. I'm that extreme introvert. So what I'm curious is with that property, because that owner, they had their R&M budget like so much lower than I assume you can have it unless you bring it in-house. Does that kind of penalize them? Because you're going to end up having to buy it at a higher cap rate based on their net operating income.
Yeah, but so there's a good question, and the cap rate conversation is a very interesting one. So in this particular case, yeah, you are buying it at a higher cap on paper, but I always have to factor in my expenses. So I look at the seller's income, whether it's a T12, T3, T1, whatever you want to use, and then I factor in my expenses, including increased taxes, right? And then whatever else needs to be increased, payroll, R&M, whatever that number is, factor in my expenses, and then that's the cap rate I'm buying at, right? Mm-hmm. And that's a more accurate reflection of what you're actually buying, because you could be buying what looks on paper to be a 7, which would be a good cap rate, but once you factor in your numbers, you may actually be a 5 3/4 cap rate, right? And so you can't really go by in-place numbers necessarily. And there's a property down the street that we just bought last November. The in-place cap rate when we bought it on in-place numbers was a 2.2% cap rate. And that's why most people didn't buy that property, because they just couldn't wrap their heads around it. And so we had to strip out some of the seller's expenses and put ours in. So we were actually buying like a 4 1/4 cap rate. Okay. So, but even still, some people turn their nose up at that property. That property is on the water, sits right next door to 2 high-rise towers. I do a lot of posts about the property just because it's a good story. We're getting $350 to $680 rent increases on renovated units over the classic units.
Wow.
Now,
Whoa.
you let that keep rolling out, and then you tell me, was it a good deal?
Probably.
Right?
Sounds good.
You can't always buy it based on the cap rate. And so that's a good question that you asked, because people need to truly understand cap rates, because what's true for the seller may not be true for you, right? Going in. So there's two different going in numbers, I would say.
So on the flip side, then, when you're going to exit, are you assuming the next buyer is like you and they're going to put their own numbers in? And if that's the case, then how do you plan your exit cap? Or are you going more off the sales comps?
Yeah. So I guess the answer to that is all of the above. And so on my expenses, I try to make our properties run on the expense ratios that is really should be market, right? So 45 to 47 up to 50% depends on the age of the property. If you got a brand new property, which we don't buy, you're looking at closer to the 42%, depends on how new and, how efficient it is. So on my exit expenses, I'm assuming that our numbers are going to be in the ballpark for what, your average buyer would be. So that's what I'm looking at. Sales comps, you consider that, but the main driver of these properties, as we know, is based on the income, right? Based on the NOI. And so let's just use this property that I just mentioned, this in Daytona Beach, this property we picked up, arguably a 4 cap, right? So when I'm planning our exit cap, in most of our holds, some are different, but you have to pick a number, right? So almost all of our assumptions are 5 years. They always start at 5 years, and then we adjust from there. So let's just say a 5 year, and if you were to buy a 5.5 cap today, you want to project out 75 to 100 basis points spread north of that number on a 5-year exit. Now, these are all projections, right? So there's always something you want to clarify with people. We know that they're pro formas. We know that they're projections. It's not exact. Nobody knows what you're going to sell for in 5 years. But it's just a kind of a rule of thumb, right? And so this property that we bought for a 4.5 cap, we have to look at, okay, what's the average market cap rate in general across the board? And I think everybody is safe to assume that it's 5.5, right? Just general numbers. So you can assume that, okay, assuming we bought this property at a 5.5 cap, which is market, let's assume that we're going to be exiting this property at a 6.25 to 6.5 cap. So that's my exit assumption. Even though I bought it at a 4, I'm not using that 100 basis point spread that I mentioned a second ago. I'm using what the average market should be going in, because that 4 cap or that 2 cap is really an anomaly. It's not really true, especially based on the age of these properties. They're value add properties. And if it's a brand new Class A property, then if it's a 2 cap or 3 cap, then it probably is what you're getting.
Right.
But that's just not what we're buying.
And so you'll go with that exit price, even if your comp is way above everyone else's of like a similar vintage and make?
No, not exactly. I mean, so we look at that exit comp rate, that exit comp or exit cap assumption, and then look at the comps on what the exits are, because you have to look at the exits today, but you also have to assume what the exits are 5 years from now for the comps, right? And you don't know what those are going to be, but you can kind of roll out. If you had access to every property's P&L statement and you were able to project out 5 years what their expected NOI was against what your expected NOI is, you could find that you're going to be close. Right. But it is something. And so when we buy a property, just like when we sell a property, I'm not looking at any one particular metric. I'm not looking at cap rate. I'm not looking at a per door price. I'm looking at all of it, because it all has to make sense.
Yeah, you're creating a story.
Correct.
So you said you left you started Inman Equities 3 years ago, right?
Mm-hmm.
So once you left and you started doing your own things, did anything change when you were sourcing deals and developing your own relationships with brokers, or did your prior experience help immensely with that?
So I think it helped immensely, because when the entire time I was working for Grant, there were some verbal agreements, I would say, and so that were not in writing, which that was enough to make anybody nervous, right? So you kind of expect the best but plan for the worst. And so the entire time I was working for Grant, I did what I was there to do, and then some. I mean, I definitely helped keep him on track and help him get, I mean, I know that he went in a different direction now, but really helped build that portfolio. I think the portfolio value when I was there, it was like 300 million when I arrived, and by the time I left, it was like 550 million. And that's when we were buying like all Class B stuff. And then when I left, they started buying Class A, which obviously that number starts skyrocketing by $100 million at a time almost. When I was there, I was involved in just harvesting, just talking to investors in general. I mean, it wasn't like I was out talking to investors, trying to bring investors into Cardone Capital. I was out talking to investors just because they would call me, they want to meet, kind of off-site and, just talk about what we're doing, talk about what I was doing. And really I was just building a relationship with everybody. So I would go to, different family office events and, and I was living in Palm Beach at the time. So I would go out and I would meet with people. I'd go to functions and socials and things like that. So really just building up my database of investors and potential partners. I'd go to the multifamily conferences and stuff. And so when I ended up leaving Cardone, I didn't leave blinded, right? I had a database that I could leverage. I had a Rolodex that I could utilize. And so it wasn't just started, like just got frustrated and left. It was like a planned exit in a way, because I gave it a certain amount of time that if some of the things that we agreed to did not come to fruition, I was going to leave. And I was planning for that. And it never happened. So I left and I never looked back.
So along with that database, are there any systems that you picked up from your time, either as, development, project management, and acquisition side, that helped you grow so quickly when you started your own business?
So, I mean, I guess the system was, it's all hands on deck, right? It just goes back to what I said a minute ago. It's like, you don't have to be the smartest guy. You just have to out execute the smartest guy, because the smartest guy is stuck in analysis paralysis. They're running the numbers 15 times before they make a decision. And at the end of the day, it's like, you don't have to get that far in the weeds, man. You could just know what you know and then go for it. And so for me, I was focused on building out the database of investors. So you want to make sure you have that pool readily available. And then I had a second pool of potential partners that I could partner up with to get deals done with. Because when you're starting out, it's like, you don't have a track record as a GP or KP, a sole lead sponsor. So you have to build that track record really over a 2-year period of time before a lender is going to give you a loan. This is speaking to the agency space. Before the agency is going to give you a loan, they want to know that you have that track record, right? So you got to have time to build that track record out. So built out the database of investors, built out the database of potential partners, and then built out the database of brokers. And all this is kind of happening in tandem together. And on brokers, you just focus on building out the relationship. A lot of them knew me from the past and, my time with Cardone, and they knew when I left. Obviously people are skeptical. So you just build out that reputation, and, it's always a chicken and egg thing, right? You've got to get your first deal done. And it's always the first and most difficult one to do is the very first deal. So once you have that first deal done, now you have a story. Now you have a track record. Now you have a property. And so that one, it's almost like making your first million. They say it takes the hardest million is the first million. And then every million thereafter is so much easier. So same thing applies for your property. The first property is the hardest property to buy, but every subsequent property thereafter is so much easier because now you have a track record. Now you have a story. And I wanted to focus my time and attention on building out that reputation as a closer. As someone that does not go into contract and drops a deal. We're not known to go in and renegotiate pricing, not asking for credits or anything like that. So, that's just the reputation I focused on building out, was one that was easy to deal with, but firm. And it was going to get the deal. If I get the deal tied up, I'm going to take it down. So, we just don't, there's some people out there that tie up properties and then really don't have any intention of closing on it. But for me, it's like I do so much due diligence up front that I'm pretty much there before we even go into contract, like mentally wise.
Are you struggling to understand how to underwrite multifamily properties? Hi, I'm John Stober, and I completely understand your problem. I thought underwriting would come naturally to me due to my background in finance and accounting, but I quickly found out that there aren't a lot of resources that cover this subject. I had no idea whether what I was doing was right, wrong, or just original. I don't want you to have to pick up little nuggets here and there like I did. So I wrote an ebook called How to Analyze Big Apartment Buildings and Make Them Feel Small that puts together all the pieces of the puzzle. We're also giving away a deal analyzer with the ebook, and they're both completely free. Don't wait as long as I did to start chasing financial freedom. Go to bit.ly/underwriting ebook and get your free copy today.
Could you talk about how do you do that due diligence up front? If you're not under contract, you can't walk every unit and do things like scope the lines.
Right. So, in the database that the brokers give to you during the underwriting process, right? So all the financials, they give you all the tax bills, they give you the rent rolls. And this is speaking in general. This obviously goes into, if you're dealing with a well-seasoned broker or whether you're dealing with a mom and pop and you have to pull information out of, it's a little bit different story. But assuming that, you're dealing with like a Marcus & Millichap or ARA or JLL or Collier or the CBRE, the bigger shops, you're going to get access to all these files all at once. Other than, there's going to be some that are going to be saved for, once you actually go under contract, but there's enough that you can dig out during your due diligence process by talking to the people, talking to the residents, going there at night, looking at the property at night, how, who's in the parking lot, who's hanging out, who's willing to, people see you walking around, hey, you live here? Yeah, I live here. What do you think about it? I'm thinking about moving in. The people tell you the truth, right? And so you kind of learn, some kind of, I guess, off the record information that way. And then, just looking at the comps, shopping the comps, knowing what the comps are doing. And that particular property that you're looking at, there's only so much, you're not going to get the survey necessarily right away. Sometimes you're not going to get a lot of the, more personal information until you're under contract, but that's some of the stuff that comes in time. And, during your due diligence process under contract, you still, if there's something that's you cannot live with that you discover, you can obviously get out of the contract. But unless you're just buying a crappy property, there's really not a whole lot to be concerned with, especially the more you do it, right? It's just all about becoming familiar with your craft.
And so when you said, you're going to these properties, talking to residents, are you personally doing that, or are there markets where, you can't take 30 minutes to drive there? In which case, how are you doing that due diligence?
Yeah, so most of the properties that we've bought, I put my foot on every single property, right? So I don't send my staff out on my behalf, and because if my investors ask me, hey, have you been there? My answer has to be yes, right? And so I'll go there, and or my staff will go there, and we'll walk the property. Maybe the same time, maybe at different times, depends on schedules. So most of the properties I do get to, because most of our properties are either a 2-hour drive, or no more than a 2-hour drive, or a 2-hour plane flight away, and most of the time it's an hour plane flight. So it's really easy for us to access everything, which is a big benefit for us being here in Atlanta. Is I get direct flights anywhere I want to go.
Yeah.
So that's a benefit for us. It's like, I get sent stuff in Colorado and Texas and, Arizona. I like all those places, but, for me to hop in a plane and fly to Dallas or San Antonio, or wherever, it's like, I like those markets, but why I'm going to do that when I can still access the Southeast much faster, already in a market that I'm already in. So it's, we're going to be going into those areas, especially Texas. We just have not gone that direction yet for that reason only. But now we're structured to the point where we can stretch out a little bit more.
And so you mentioned also when you went off on your own, you had that Rolodex of partners. What other partners did you need to close the deals?
Yes, it's a great question. So it goes back to something I said a minute ago, to where when you buy your first deal, and really, your first 5-10 deals, however many deals you buy in a 2-year period, because that's really the goal that I guess that people should set if they want to become a serious investor or syndicator or multifamily owner operator, I should say, because that comes in many different flavors, I guess, is you have to know that the lenders are always going to ask, well, what's your experience? What's your track record? And the biggest rule of thumb that I learned a long time ago is you got to have that 2-year window. You need that 2-year of expertise of market experience. So it's a good goal to set. And it goes back to the chicken and egg thing, right? So, one of the first properties that we bought was a 50-unit property on the northeast side of Atlanta. And, I was experienced, but not as a lead sponsor, right? Because sadly, the experience that you gain from years of working for other people, yes, it transfers, but it doesn't translate, if that makes sense. Meaning that the lender doesn't look at it that way. They're like, okay, you know what you're talking about, but you haven't yet bought anything. So basically you have no skin in the game. That's ultimately what they're looking for. And so to do that, I had to partner up with people that had the net worth, that had the experience, and that had the liquidity, because you have to solve for all three of those. And you may have the net worth and the liquidity, but if you don't have the track record, you may not get the loan. And then again, on the other hand, if you have a 2-year track record, but you don't have the net worth and liquidity, you're not getting the loan either. So you've got to solve for those pieces of the puzzle. And to do that, you got to partner up. And that's the biggest mistake that I see a lot of people making today, is a lot of people starting out. And I don't know that now is a good time for people to start out per se, but if you are going to take that leap, the biggest suggestion that I can make to people is do not be afraid to partner up. Do not be afraid of giving up a percentage of the deal, because that's what it's going to take to get it done. It's like at the end of the day, you have to ask yourself, how committed are you? Because if you have to give up 40%, 50%, 60% of the deal in order to get a deal under your belt, then you need to do what it takes, because there will come a time to where you can go buy a $30 million deal and be able to do it by yourself, right? And so that's the biggest mistake I see people making, is that lack of willingness to sign or to give up that percentage of a deal. And I use that as an example because there's a particular property in Kentucky where this new sponsor that has the net worth, he has the liquidity, but he doesn't have the track record. And he had a Fannie Mae loan that, it's either Fannie or Freddie, but the lender called me and said, hey, we have this guy. He has everything that he needs. He just doesn't have the track record. Will you be willing to sign on the loan for this guy? I said, sure, I'll do it, and we'll do it for 10%, which is really the market for doing something like that. And, the guy was just so stuck on not doing it, to the point to where for the first time ever, I said, look, I'll do it. Just pay me X amount of dollars at closing, and I'll do it for 5%. And the guy, he said, let me think about it. And then he turned it down. And I said, look, if he comes back, the number's 10%, take it or leave it. Because it just goes to show you that he's so focused on not giving up anything that he may actually not get the deal done unless he goes with a lender that he's going to, with a bridge lender, that he's going to pay a lot more interest. He may get the deal done, but he's looking at paying 6% interest versus 3% interest. Now, you tell me if that was a smart move, right? On a deal that did not need bridge debt.
Mm-hmm. So as the new sponsor, though, one thing I would worry about is, if I'm locking up a deal for 5 or even 10 years and I'm giving away a huge piece of it, how do I make sure for my investors that I'm making enough money where I'm incentivized? Now, I'm not just going to go buy more deals that, put more money in my family's pocket.
Yeah. I mean, that comes down to the operating agreement, right? So it just depends on what you're willing to structure with, whoever's at the table with you. Just, using that example, let's just say you had to do a 50-50 with somebody, just for easy math. And ideally, let's just say they're bringing a lot of the pieces of the puzzle together, like the net worth, liquidity, the track record. And let's just say they're bringing half the equity. I'm just keeping everything 50-50. And then you bring half the equity. So really, your investors are still making the same on the 50-50 structure with that partner as if you were to own the deal 100% yourself. They're all being paid pari passu the same amount. right? And so however you're structured your deal with your LPs, in a deal that you own 100% of, it's the same math as if you had a partner in the picture. I just think some people just get locked up and restricted in that, just that mind says, I don't want to give it up. I don't want to give it up, but neither did I, but I did it. And when I first started, I couldn't buy a 50 unit property by myself. And now, here we are buying a $30 million property, and I qualify for the loan by myself. I couldn't do that 3.5 years ago, And so, but it took me giving things up or finding the right partners, because my whole thing is, it's not about the money, right? And I taught this when I'm talking to investors and everybody else. It's not about the money to me. It's about the partnership. Because even if you have an LP, even though they don't have any controlling interest, you really want to make sure who that person is, because that person can be very annoying, or that person could be a really good fit. So you need to look at investors or a 50-50 partner as a marriage. It's like, do we get along with this person? If the answer is yes, then it could be a really good arrangement. If you're just after the money, you could take some money from some people that may not truly understand how things work, and will get frustrated and upset and start causing this big stink. But it really comes down to their lack of knowledge, So, I mean, I think that people just need to be open to structuring a deal in any way that makes sense for them.
Do you take that same approach when you're looking, or when you were looking for like a key principle, it's a good fit, or was it like much more thorough vetting with background checks and things like that?
No, it's people that it comes down to me building up the database with the people that I had in my Rolodex of potential partners. It's people that I have known for, a couple years. So I had just natural vetting over time, right? It's not just, we just met and then, we did our due diligence on each other and we decided to jump into bed. It was more, you learn that person. You knew their experience. You knew their personality type. You got along together. You go to have dinner together, have good conversations. So it wasn't that, you just got introduced to people and, and you either hit it off or you don't. And if you don't, I wouldn't do it, And the only ones that I've ever, there's one in particular that I was introduced to in Dallas at a conference. A lender introduced me to this guy. Said, "Hey, I just want to introduce you to each other because something may come of it at some point." So we had a nice steak dinner, and then a few months later, I was in a situation to where I had 5 deals under contract at one time last year, which I would never recommend. Okay, do not do that. Got them all done, but it was very stressful. So, but in doing that, and I don't remember if it was, I think it was liquidity, because I had money tied up in earnest money here, earnest money there, everything else. And so I think it came down to a liquidity requirement that I needed for this particular 2-property portfolio we were buying. And in order to do it, I needed to bring in somebody. And so I happened to be talking to the lender that introduced me to this guy in Dallas. And he said, "Hey, you remember such and such that I introduced you to, that we had dinner together?" I said, "Yeah." He said, "Well, I can talk to him, and I know that he'd be willing to come in and help you. He has the liquidity. He can help solve for this part of the puzzle, and he'll probably do it for 10%. And so we talked about it. He said, so me and the guy got on the phone. We worked it out really quickly, but we got along at dinner, and it was just a really good conversations. And so that was a natural fit, and it came down to just personality type, and this guy building his company from the ground up. So it was just a little bit easier. This is one of those things where you click. It's almost like, you're guys, right? So it's almost like meeting a girl. It's like you either hit it off or you don't hit it off. If you don't hit it off, don't waste your time. But if you hit it off, then maybe you should ask her to dinner or marry you or something, right? And so, but it's one of those things you really need to groom into. And sometimes it's like one of those things you just know that like, and sometimes you can't even explain it. It just feels right. So some of it can't be overanalyzed. You just have to really trust your gut in a sense. And, so I just say just build out a database. Now, I'm not saying that you couldn't just be introduced to someone and they come in and sign on the note, because it can work. But I would, prefer for someone to at least have a database to work from. And if you had to resort to the unknown, then go that direction at that time. But don't go there if you don't have to.
Mm-hmm. Well, Ben, unfortunately, we're running up on time.
So I was just getting started.
Yeah, well, I guess we'll have to have you back on and keep going. But I wanted to get to our last section of the show that we call the Fast Five, and they're the same 5 questions we ask every guest who comes on. You look ready.
That was my nervous hands.
Well, okay, so question number 1. If you had to start all over again and you were in your early 20s, how would you do that?
Man, I think that, really the way I did it, I would focus on building out my database of potential partners. I would focus on building out my database of potential investors. And then I would focus on building relationships with brokers. That's how I would do it, because over time, it's all going to come naturally, because you're going to know the steps to take and the order you need to take them in. It's just, I think those 3 components are very important. And just don't look back. I wouldn't worry about what people say. I wouldn't worry about being too young. I think that's one of the reasons why I waited until, I did, is because, if you think that, let's just say you're 22 years old, right? I'm going to go out and buy my first multifamily. Well, maybe you can. And if you have those relationships in the database, why not? But, you don't limit yourself, because you never know. Because a lot of times, if you have to spend the next 10 years getting no's, eventually you're going to get to that yes. And then you're going to have all those years of experience that is only going to make you better. It's going to make you stronger and faster. And so really, just, you don't have to know it all. You can read every real estate book you can get your hands on. At the end of the day, they're all regurgitating the same information, right? So you just have to come to the conclusion, you just have to execute. That's really what it comes down to.
Execution, super important, and so is that database.
Yeah.
Question number 2, how do you see young professionals adding the most value to experienced operators in the space?
So how do I see what?
Young professionals adding the most value to experienced operators.
Yeah, good. So I think going above and beyond, bringing value, like there's a potential lender that, that I work with quite a bit that, look, I get calls from finance guys all the time, right? And at the end of the day, it's almost like a commodity. What I can get from one shop, I can get from 50 shops, right? And so you have to set yourself apart. And the way that he sets himself apart is he's willing to do a lot of legwork, like a lot of the documents that I would typically have to send over to a lender. He's willing to do that work for me, which really takes a lot off my plate. But even just take it a step further, this particular originator has a database of investors that have just contacted him over the years and say, hey, if you ever come across something, let me know. I need to put some money to work. And so now he's leveraging his database to make equity introductions for us that nobody else is really offering. And he's not charging us a fee for doing that. He's willing to make these equity introductions because he's incentivized to get the deal done, because if he gets the deal done, it's when he gets paid, right? And so who do you think is going to get my call every time I have a new deal to finance? He's going to get my call, right? And so at the end of the day, he's not guaranteed to get the business, but he is guaranteed to get the call, right? Because he is going above and beyond. And it just so happens with this particular lender, they have their own balance sheet, but they also are Fannie Freddie DUS lenders. But there are some shops out there that are not as entrepreneurial. And I think the best way that you can just add value is just think creatively, think outside the box. You gotta do what your competition's not doing, because especially if you're selling what is perceived to be a commodity.
Awesome. So question number 3 is, what's the biggest mistake you've made in your career, and how have you adjusted your business because of that?
I think the biggest mistake, to be very honest, and this is something that we're getting better at ourselves, is because you can't be the jack of all trades, right? Jack of all trades, you're the master of none, right? And so, very good question. And we've been really good at sourcing deals, sourcing equity, getting the deals done, operating the deals, and being very efficient in our renovations and everything else. But one thing we have not been, and we've been in the properties that we actually, and this is up to the beginning of COVID, right? That in the properties that we're paying out monthly distributions, we're paying out monthly distributions every single month. And the properties that we're paying out distributions every quarter, we're paying out every quarter. And then, obviously enter COVID and kind of threw things off a little bit. But one of the things that you really want to get good at least we do, is reporting. Because at the end of the day, it's all about communication. And a lot of our investors follow us on social media. And so when we do a lot of our posts on social media, a lot of our investors see that and they get updated ongoing, just random posts just throughout the week and stuff. And then we also send out monthly investor reports. Now, we want to make those stronger, right? And so we want to be better at doing that, because we had third-party management in the picture that if reports are due to us on the 15th of every month for the prior month, sometimes they didn't send us those reports until the 19th or the 20th, sometimes the 25th. Sometimes I had to ask for them. And so what that happens is, once we get that owner report, then we have to take that same information, summarize it, and send it out to our investors. So what that means is, it hasn't been consistent. Like, if it's on the 15th, it needs to be the 15th. If it's, if we get on the 15th and we tell our investors that we're going to turn it around in 48 hours, I want them to expect it on the 17th every single month. And so it hasn't been that consistent as I'd like, because our hands have been tied to third-party partners. So we're in the process actually of bringing management in-house on some properties for that reason, because for us, it's not about a profit center. It's about the control and getting that reporting done on time every single time. Because I will tell you that we have been delayed for those reasons, but at the end of the day, we're ultimately responsible, right? We take responsibility for that. We also take responsibility for fixing it, which we have done and we're doing now. So I think that's the biggest mistake, is not having, even though we had the third parties, but I don't want to put all the blame on them, because ultimately it's on us, right? And so just making sure that reporting and that communication is down pat, because I would say that that's probably just as important as investors getting their distributions on time.
That's awesome. That's awesome that you bring it in-house too.
Yeah.
Question number 4. What's been your favorite way to incorporate technology and social media into your business?
It's a good question. So, it goes back to, what I said when I moved back to Nashville, started my marketing company. We started a very successful marketing company, did really well. So both on the technology side, utilizing mobile devices, as well as functional websites that are intuitive, meaning websites that function on a desktop, but also immediately translate over to a mobile device just by native, get the technologies uses like native identification or something like that, to where the handset notices the website, it formats itself to where it kind of repositions certain blocks and pictures and text and stuff like that, so it kind of flows. But that, as well as obviously staying on top of social media, and then you have Facebook Marketplace. Man, that's probably one of the biggest, best kept secrets for people, is because this goes back to 2 years ago when there was not a lot of people using it, and surprisingly, there's still not a lot of people using it today compared to what it should be. But Facebook Marketplace is free, right? It's almost like Craigslist, but Craigslist is kind of seen as like the bottom feeder. And, you still probably want to use it just because people go there. But I think that Facebook Marketplace at this point is a little bit stronger. And it's just staying on top of those technologies like that, because you can put up posts. I mean, I'm going to tell you, we get hundreds of leads a week just from a post that we got to do once a month. And it just continues to harvest. But also on the other side of that is for Google, we create ads that, your keywords, your AdWords. So we implement that. Most owner operators don't do that. They'll go to an ILS like rent.com or RentPath, that they'll get a subscription and they'll do a post, create a profile, and it rolls out through multiple platforms. But the challenge with that is, let's just say that somebody types in, 2-bedroom apartment in your city or the city where you have a property, and guess what's going to pop up? Rent.com or one of these other major ILS are going to pop up with 2-bedroom apartments in your city. And then they're going to click on that. And then that consumer goes to the rent.com's website, and then you're buried in among thousands of others in that area. So the idea is to control that keyword, right? And you can control that keyword, and secrets that I will not give away here, but you can control that. So the idea is to really learn the technology and how to implement it, but really just utilizing free things like Facebook Marketplace and utilizing like Google keywords, Google ads, Facebook ads, things that a lot of multifamily competition is not really doing. At least in my opinion, I don't think they are. Not from what I've seen, but maybe, different markets a little bit different, of course, but that's what we do. I mean, and having an intuitive website that you can use to filter in, leads, you can't get away from that.
The secrets are going to be on the second interview, just to let everybody know.
So the last question is, what book has been most influential to you along your journey?
Man. There's several of them cross my mind, but I think I would have to go back to the one that was the most inspiring. And it's going to probably be the most polarizing one, but it really, really is a good book, and that's called The Art of the Deal, right, by Donald Trump. And so, because in that book, it talks about just really out of the box negotiations and out of the box structures that he was able to put together. And, in some particular cases, he was like, he had, this land to build a high rise, and he wanted to build it higher. So the only way he could do that is go buy the air rights to the guy next door so he could build it even higher. But nobody was really doing that at the time. And so he made that popular, right? And so you're really maximizing the value of the land that you're building on. And so that book had a really large impact, not just in real estate, but just in general, just thinking, like critical thinking, negotiating tactics. So I'd say if I had to pick one, I'm going to pick that one, but that's just a general, book, I would say. But if you wanted, something more specific, I mean, there are other really good books I could recommend.
Mm-hmm. You want to throw a few off?
Yeah. Let me see if I've got several of them back here. Okay, here's one. And I'm not being paid to do this, by the way. So all these authors should probably actually send me some royalties.
Yeah, you need an affiliate link.
I should. This one,
Emerging Real Estate Markets, by Dave Lindahl.
Yeah, it's a really good book.
Mm-hmm.
It really is. It teaches you that there's a cycle in every cycle, right? So no matter what cycle we're in the economy, there's always a market, right? This is a really good one. Let me see. There's one in particular, I'm not finding, but it's called What Every Real Estate Investor Should Know and 37 Other Key Metrics or something like that.
By Frank Gallinelli.
Gallinelli. Yes.
Yeah.
I think that should be in everybody's toolbox, because it serves as a good reminder, right? Because there's many different metrics of looking at an investment, right? So you have your GRM, you have your cap rates, you got your NOIs, you got all these metrics, right? And so you, as an investor or as an owner operator, you're going to just naturally gravitate to the ones that you like the most. And then you forget kind of the other ones because you don't really use them that much in your conversation. You're just like, I know that's a simple calculation, but how's it done again? Mm-hmm. So it's good just as a point of reference to have that. That's a really good one. I've read that one, man, several times, just it's just a really good. I just think it's for anybody, especially if you're just starting out. It's a really good one.
Yeah.
Dang, I mean, there's a bunch, man.
I think that one's what
here it is,
every real
actually.
estate investor needs to know about cash flow.
This is it. Look, I told
Oh,
you.
yep.
Yeah,
there it
whatever,
is.
whatever real estate investor needs to know about cash flow.
I'm not
36
lying. I got it. Let's see. And then I got this, which will make your eyes bleed, make your head hurt too. But
commercial real. Okay, I haven't read that one. I'd probably be interested in that one. There's another textbook that I've read that I really like called
900 pages. Have fun.
This one's yours is by Peter Linneman, right, John?
Yeah, I don't even remember the name of that, but I like those textbook like
Those things
numbers.
are dry.
Yeah, and I'm actually reading. I'm reading one right now called Practical Property Management. It's actually really good. It's just very basic property management, but it's actually more in depth than just your basic information. But it's really good. I just cracked that open not that long ago, so I read it when I get a chance. But yeah, look, I hope that helps. Those books right there, man, especially the emerging real estate markets and that what every real estate investor needs to know about cash flow. Man, I think it's good. And Frank Gallinelli, if you're watching this, I want to know how much you make off that when off my recommendation.
Send the affiliate links.
Just send me a check. Just
At least a Christmas card.
I like mailbox money. I don't need a link. I need some mailbox money. Cash flow.
That's right.
But no, I mean, look, I love books. I love podcasts. One thing I will leave with this, which is one of the things I learned back in 2000, actually. And it's something that really changed everything just in many ways. So you can pick your subject matter, right? Whatever that subject matter is, say it's marketing or real estate, whatever it is. But I heard that if you read on the average of one book a week in your subject matter, right, whatever that subject matter is, one book a week for an entire year, that you'll have the equivalent of a PhD in that subject matter. So it's 52 books a year in your title or your subject matter. You will be the equivalent of a PhD. Now, I didn't make that up. I don't want any PhDs out there contacting me because that did not come from me. But I will say this, that whether that's true or not, if you adopted that and you implemented that, right, how much knowledge would you have in a subject matter? In the case of real estate, like how much would you know? Like, just think about it. And so when I learned that in 2000, I don't remember the month, but it was definitely the year 2000. I've been doing that ever since. So for 20 years, I have not read a book a week every single week for every single year. But at the beginning of that period, I was just crash course. So I was pretty close to hitting that. So let's just say that over time, I did a book a month for the past 20 years, which is probably very accurate. Just think about that. That's a lot of information. I don't claim to know it all. I think that if you ever do, then you're in the danger zone.
Life's
right?
got to
Because
teach you a lesson.
you got to keep learning, got to keep growing. I like to help people, like to motivate people. Because at the end of the day, it's like I've made it to a good place. I want to keep growing, I want to keep building, but at the same time, I like, especially for the younger generation. I'm not that old. I think about millennials. I'm like, this feels weird. I almost feel like I don't know. It's just strange. It's like, but anyways, younger people that are just starting out, you want to be there to motivate them, right? You want to encourage them. It's like, I can do this. Like, I literally started with no extra money. Like, I had no money to put in the first deal I bought. Nothing. Zero. And now today, my net worth is way above zero. So It's in a much better place than it was, for sure. But it's just because I put the blinders on. I knew I knew what I wanted to accomplish. I knew the property types I wanted. I knew the markets I wanted. And you have to know when to say no, even though it's a good deal. Like, there's a good deal that just came across our desk 2 weeks ago. That it was a good little deal. It's a small property, like 50 units, is in a good little location, but not really in a market that we're just not ready for. I don't think we'll ever, actually, it's a market we probably will never be interested in. But it's right for someone, especially if you're just starting out. But for me, it's like, I had to tell, my analyst, I'm like, we have to know when to say no. Like, because we're going to use our time and energy to buy another 50 unit deal. But why, when we have a $30 million property right now under contract that we need to get closed, which is going to be my biggest one yet. Which is going to open up doors to more things, right? Because now the seller is also talking about selling us their other big properties in the same market. And so that's going to be a really big thing. But really, it's just knowing when to say no so you can take advantage of the good opportunities. And you just got to know when to jump in, because at the end of the day, if you get caught up in analysis paralysis, and I see it happening by people, that you could literally get so far in the weeds that you can actually overpay for a property because you're so far in the weeds. Or on the flip side of that, you can offer so far less because you don't really know your numbers because you're so caught up in the weeds. Or you're just not going to make a move at all, and you're going to be sitting still for the next 10 years. There's a guy I met at a real estate, at a local RIA a couple of years ago. And, this investor, he was investor, or at least he called himself that. He said, I've been coming here for 10 years and, I've been talking to a bunch of people. I'm looking to put some money to work. And I said, oh, really? How much you put to work? Well, none. I've just been, learning and just, kind of just attending. I said, how much have you invested in? Like, none. I'm like, but you're an investor? It's like, I said, sir, you need to shit or get off the pot. You either need to do something or you need to stop coming here. And I just told him like that. I never went back. But the reality of the story, and that's not because I was scared to see the guy. He's like 80 years old. But the point is, it's like, you got to, if you're going to do it, and that's not saying just go buy anything. I'm just saying, like, you don't have to be there for 10 years before you know when it's time to make a decision. And this guy, for 10 years, I mean, are you kidding me? Like, what's the problem? So you don't want to look back and wish you would have, And so, that's my only advice, is just go for it.
Well, Ben, thanks so much for joining us on today's episode of the Millennials and Multifamily Podcast. If anyone wanted to get in touch or learn more about you and Inman Equities, what would be the best way or ways for them to do that?
Yeah, so thank you for that. So you can email me, binman@inmanequities.com, or they can email Stephen Bush at sbush@inmanequities.com. I always throw my cell phone number out there. You can text me, call me if I'm available. I'm known to pick up the phone. 615-513-3088 is my cell number. And then also they can find us on all the social media at Inman Equities or online at inmanequities.com.
Thank you for listening to the Millennials in Multifamily Podcast, brought to you by Kronos Investment Partners. If you enjoyed the show, please leave us a rating and a written review at iTunes so that we can connect with more people. Finally, head on over to kronosinvestmentpartners.com and sign up for our newsletter so you can stay updated on everything we're doing. If you're interested in partnering with us as we find new opportunities, you can also schedule a phone call with us under the Contact Us tab at kronosinvestmentpartners.com.